So let us start. Welcome students, welcome to lecture number 38 where we will be covering module number 6 and the subject financial management. So module 6 as we know is nothing but capital structure and dividend decisions where we have already seen the theory part in our lecture, that is lecture number 37. So today we will be seeing how to determine and estimate the leverages. Okay, and in next class we will be seeing EPIT and EPS analysis. So today we will be covering about leverages. So let us first understand what is the meaning of leverages. So it refers to the use of fixed cost instruments to maximize the return potential to the shareholders. Now, fixed cost instruments, as we know, is nothing but interest to the debenture holders, interest on the bank loans or term loans, or fixed dividend to the parent shareholders. So, leverage uses this fixed cost instruments in order to make sure that it maximizes, increases the profits to the shareholders, the earnings to the shareholders, or the returns to the shareholders. Because we know that the equity shareholders are the owners of the company, and after paying off all the fixed cost instruments or expenses, whatever remains, it goes to whom? To the equity shareholders. So leverage has various variables such as revenue, cost, EBIT that have impact on the returns available to shareholders. See students, revenue is earned out of the sales that is made, okay, during the month or the year. Now, sales is not a fixed element. Sales is a variable element. Why? Because we do not know what is the volume of sales that is going to be every month or every year. See, it may so happen that the sales may shoot up in a particular month and may not, maybe zero in a particular month. So depending upon the demand and the supply, the sales will fluctuate. So leverage has various variables. Variables means which keeps changing and which is not constant. So revenue will keep changing every year. You cannot estimate to have the same revenue, so the sales will keep on changing. Next, the variable is cost. Cost is nothing but you can take variable cost. Variable cost is those costs which are related to the sales. So as sales increases, variable cost will increase. As sale decreases, variable cost will decrease. It is not fixed cost. Fixed cost is those costs that remain fixed irrespective of the level of revenue. Okay, like we say fixed cost, like rent. Every year or every month, whatever rent is payable, it remains fixed. Irrespective the company, the enterprise has made a sales or not, you have to pay rent. So it is a fixed expense. Variable expense is an expense that is directly related to the sales. Like suppose if you are manufacturing a particular product, okay, and if your sales is too very high, obviously to manufacture so many products, your maybe your fuel expenses, your electricity expenses, okay, will, or your salaries, that also will increase. Your wages, that also will increase depending upon your volume of sales. So variable expenses is directly related with the volume of sales, so it is variable. Like if sales is high, variable, the cost will be high. Sales is low, cost will be low. And EBIT is nothing but earnings before interest and tax. So this interest here in EBIT is nothing but interest to the debenture holders. Okay, and tax is nothing but the final income tax that is paid by the company to the government. So all this, the sales, variable expenses, and the EBIT obviously have a great impact to the returns to the available to the shareholders, because higher the sales, lower the cost, higher earnings, you will get more returns, okay, will be available to the shareholders. It involves a study of relationship between two or more variables. Yes, leverage is having a relationship between two or more variables, which will ultimately, okay, will aim at the potential returns to the shareholders. So this is meaning of leverages. Now, format to derive at earnings available to equity shareholders. See students, ultimate thing of leverages is to give potential returns to the shareholders. Now, how do you arrive at earnings available to equity shareholders? This is nothing but returns available to equity shareholders. So how do you start with? First, you take this sales. Sales is nothing but your revenue that you're generating from the product that you're either manufacturing or selling. So you first take sales. From sales, you less variable cost, you get contribution. So this is a fixed format in order to arrive at earnings available to equity shareholders. So what do you do? First, you take revenue, that is the sales. From sales you minus variable cost. Now the variable cost, as I already told you, is directly related to sales. Sales increase, variable cost increases. Sales decreases, variable cost decreases, because variable cost has direct relationship with the sales. When you minus the revenue with the variable cost, you get contribution. From this contribution, when you minus the fixed costs are those costs which remains fixed irrespective of the level of sales. So from contribution, when you less the fixed cost, you get EBIT. Now what is EBIT? Earnings before interest and tax. Now see students, from this earnings before interest and tax, first you minus the interest. So less interest. So if interest is gone, you will remain with EBT, that is earnings before tax. Then from this EBT, you less this T portion, that is a tax portion. So less tax, you get EAT, that is earnings after. Once you have deducted tax, the next is to deduct the preference dividend, because obviously preference shareholders are given preferential treatment over equity shareholders in respect of payment of dividend. That means whenever you are getting earnings, this is earnings after tax, whenever you're getting earnings, first out of that earnings, the preference shareholders are paid. Students, remember, whatever at last is remaining after paying the preference shareholders, the remaining portion goes to the equity shareholders. So from equity, less the preference dividend, you get earnings available to equity shareholders. So this is a format where you can arrive or derive at the earnings or returns available to equity shareholders. So it is very simple, students. Once again, because this format is needed for us to solve the problems. So first, from sales you minus variable cost, you get contribution. From that minus fixed cost, you get EBIT. From EBIT, first minus the I, then minus the T, then minus the preference dividend, you get earnings available to equity shareholders. Next. Next, there are different types of leverages, students. So there are three different types of leverages here, that is operating leverage, financial leverage, and combined leverage. Combined leverage is nothing but a combination of operating and financial leverage. Let us first understand what is an operating leverage and how do we calculate operating leverage. So meaning, it results when the change in the operating profit of the firm due to the change in the sales revenue. Okay, it determines the degree of operating risk. Students, to what is operating profit? In order to carry on the operations, okay, whatever expenses is involved, okay, and whatever sales is made, when you minus both, you get the operating profit. So operating leverage basically will tell us that if there is a change in the operating profit, okay, there will be a change only when there is a change in the sales revenue. See, for example, I will just show you here. See, students, here, if the sale changes, if the sale is varying, then only your contribution will change. And if your contribution changes, it will impact your EBIT. See, fixed cost is remaining fixed. Operating leverage takes into account only the operating profit. Operating profit is nothing but your contribution. Contribution is your operating profit. That is only those expenses which are incurred in carrying out your operations. Okay, revenue from your operations becomes your sales. So if any change happens in this contribution, then that will obviously affect your EBIT, students, because fixed cost is remaining fixed. That is irrespective. But any change is happening in your operating profit. And why there will be a change in the operating profit? Because that there will be a change in your sales. Okay, and that will have impact on your EBIT. So under operating leverage, we have to consider that if there is a change in the operating profit, that is due to the change in the sales, which will impact the earnings. So see, it determines the degree of operating risk. So what will be the risk involved if there is a change in the sale, and that change in the sale is changing the operating profit. So what is the formula, students? Contribution divided by EBIT. So if we see here, students, as I told you, operating leverage is only between the operating profit change and the change in the sales. Because of the change in the sales, there will be change in the earnings. So your formula is very simple, students, to remember. Contribution divided by EBIT. See, interest to the debenture holders. It is not your operating expense, students, because operating expense or operating incomes are only those which are relating to your day-to-day operations, students. Okay, so your formula for operating leverage is very simple: contribution divided by EBIT. And degree of leverage you can calculate by percentage change in EBIT divided by percentage change in sales revenue. As I already told your students, if the sales revenue is changing, it will obviously affect your earnings. Therefore, the degree of leverage, the percentage of risk, operating risk, can be calculated by percentage change in EBIT divided by percentage change in sales revenue. Next is financial leverage. It is concerned with the use of financial instruments with fixed cost or returns to maximize the EBIT. It determines degree of financial risk. So it is EBIT divided by EBT. So can anyone tell me what is the financial cost involved in raising debenture as a source of capital? Can you tell me what is the financial cost involved in raising the debenture as a source of capital? Yes, when you're raising your funds through the help of debentures, what is the cost involved? What is the financial cost involved? Yes, students? Yes, what is the financial cost involved? Students, what is the financial cost, or what is the cost of capital that is involved when you raise your funds through issuing debentures? Can you all tell me? Yes? Yes, students. Now, if I'm a company and I'm raising the source through debentures, what is the cost that I have to consider issue debentures in order to raise the funds? Yes, students. Students are there? Yes. Students, are you all there? Students, I'm asking a question. I require an answer for that. When I'm raising the funds through issuing debentures, what is the cost of capital involved? What is the cost that I have to bear, the company has to bear when it is issuing debentures? Yes. Is it the dividend or is it the interest the debenture holders? Or is it the dividend? What is it? Yes, students? To the debenture holders, do you pay dividend or do you pay interest? Yes. What do you pay to the debenture holders?
Shareholder.
I am asking to the debenture holders, what do you pay? You pay interest to the debenture holders, right? For the amount that they have lended you, that you have borrowed from that. You pay the interest to the debenture holders. So interest to debenture holders will remain fixed. So that is your financial cost. So the formula is EBIT divided by EBT. That is nothing but earnings before interest and tax divided by earnings before tax. So if you see here, okay, this interest to the debenture holders is nothing but your financial cost. Okay, so how do you calculate the financial leverage? EBIT divided by EBT. So till now we have seen that operating leverage is nothing but contribution divided by EBIT, and your financial leverage is EBIT divided by EBT. Now let us see combined leverage. So combined leverage is nothing but a amalgamation of operating and financial leverage. It is a combination of operating and financial leverage. So when we combine this two, contribution divided by EBIT and EBIT divided by EBT, when we combine, what do we get? Contribution divided by EBT. Because when combine these two, EBIT and EBIT gets cancelled. So we remain with contribution divided by EBT. So it shows the overall uh, combination of operating and financial leverage. So therefore, combined leverage is nothing but contribution divided by EBT. So how do you calculate the degree of leverage? Percentage change in EPS divided by percentage change in sales. So this is the way how do you calculate the financial leverage, combined leverage. So again, I repeat, there are three types of leverages: operating, financial, and combined. Operating leverage is calculated as contribution divided by EBIT, financial leverage EBIT divided by EBT, combined leverage contribution divided by EBT. Either you can use this formula, or whatever answer you get of operating leverage and financial leverage, combine that, multiply that with each other, you will get the answer for the combined leverage. Now let us see the problems on leverages. Is this Word document clear to, is it visible to everyone? Yes, students? Is this Word document visible to everyone? Yes? Yes, is it visible? Is it visible to everyone? Is this Word document visible to everyone? Yes, students?
Yes,
Students, are
ma'am.
you all there? Why you are not replying to whatever I'm asking? Yes. Prachi, Asha, Harshal, Prathamesh, Sneha, why are not replying? Okay, so let's start. The capital structure of Star Limited consists of equity share capital of rupees 10 lakhs, shares of rupees 10 each, and 10 lakhs 20% debenture. The articles are as follows. So what it has is, it has the share capital of 10 lakh rupees, debentures of 10 lakhs, and 20% debentures. When percentage is prefixed before the word debentures, it is nothing but interest to the debenture holders will be 20%. Sales is at 2 lakh units and at 2 lakh 50,000 units. Selling price is rupees 10 per unit. Variable cost is rupees 5 per unit. Fixed cost is rupees 4 lakh and tax rate is 50%. They're telling you to calculate operating leverage, financial leverage, and combined leverage. So we know for operating, financial, and combined leverage, we have to find out contribution, EBIT, and EBT. So let us start. So we know first we have to find the leverages both at sales unit of 2 lakhs and at sales unit of 2 lakh 50,000. So this is the format that we have already seen. First you write particulars, units, you write 2 lakh units and 2 lakh 50,000 units. So we have to solve individually for both the units. So we always start with sales first. Sale is given at rupees 10 per unit. So if one unit is for rupees 10, okay, then we are selling 2 lakh units. So 2 lakh into 10, you get 20 lakhs. Similarly, for unit of 2 lakh 50, you have to do the calculation. I'll be showing the calculation for 2 lakh. On the same lines, you have to do calculation for 2 lakh 50,000 units. Next, variable cost. Variable cost is given as 5 per unit. So 2 lakh into 5, you get 10 lakhs as your variable cost. When from sales, when you minus the variable cost, you get contribution. So 20 lakhs minus 10 lakhs, you get 10 lakhs as your contribution. From that, you have to less fixed cost. Fixed cost is directly given in the problem as 4 lakh. So you less 4 lakhs, you got EBIT. EBIT is 10 lakhs minus 4 lakhs, that is 6 lakhs. From that, first you have to minus interest, and this interest is nothing but your financial cost, that is interest to the debenture holders. Now here 20% is the interest to be given to debenture holders, and the value of debentures is 10 lakhs. So 10 lakhs into 20%, it is nothing but 2 lakh. So 2 lakh is your interest to the debenture holders. From EBIT, when you minus your interest, you get earnings before tax, that is 4 lakh. Your tax rate is given as 50%. So you less tax at the rate of 50% of 4 lakh. So 4 lakh into 50%, you get 2 lakh. So your earnings after tax is 2 lakh rupees. Based on this working, you can calculate the leverages. So first they are asking you operating leverage. What is the formula for operating leverage? It is contribution divided by EBIT. Okay, so what is the contribution? It is 10 lakh divided by 6 lakh. So your operating leverage is 1.67 times. Remember students, leverages has to be written in times. Next is financial leverage. What is the formula for financial leverage? EBIT divided by EBT. Now what is EBIT? 6 lakh divided by 4 lakh EBT. So that you got as 1.5 times is your financial leverage. Now, combined leverage is nothing but students combination of financial and operating leverage. So, what is going to be your combined leverage? Either you can multiply this 1.67 into 1.5. When you multiply, when you combine these two leverages, you will get the answer. Or what you can do is simple: take the numerator of operating leverage, take the denominator of financial leverage, and with this formula also you can calculate combined leverage. You'll get the same answer. Contribution divided by EBT, that is 10 lakhs is the contribution, divided by EBT is 4 lakhs, you got 2.5 times is your combined leverage. On the same lines, you have to solve for 2,50,000 units. So this is the way we have solved problem number 1. Is problem number 1 clear to everyone? Yes, students? Yes, is problem number 1 clear to everyone? Can we move ahead to problem number 2? Yes?
Yes, ma'am.
Okay, next. Calculate the degree of operating, financial, and combined leverage. So your units are given for A, B, and C separately. So output or unit is nothing but this is a sales output or unit: 60,000 unit, 15,000, and 10,000 units. Fixed cost is given separately for A, B, C as 7,000, 14,000, 1,500. Variable cost per unit is directly given 0.20, 1.50, and 0.20. Interest on borrowed fund, this is the financial cost, students. So this is 4,000, 8,000, and 0. Selling price is given respectively for A, B, C as 0.605 and 1. They are telling calculate operating, financial, and combined leverage. Students, before solving the problem, we know that for operating, financial, and combined leverage, we need to know what is contribution, we need to know what is EBIT, and we need to know what is EBT. So for that, we will put the solution in the form of the format. So calculation of leverages. I will show you the solving for A. On the same lines you have to solve it for B and C. So sales, students, sales is given as rupee per unit as 0.60, and for A the number of units is 60,000. So what you have to do is 0.60 into 60,000, you got 36,000, less variable cost. Variable cost is given here as 0.20 per unit. So how many units of A are there? 60,000 unit into 0.20, you get it as 12,000. You know, when you take the value of sales and minus the variable cost, you get the contribution as 24,000. From that, you have to minus the fixed cost, that is 7,000, which is fixed, students. You need not do any changes. Even let the output increase, decrease, your fixed cost will remain the same. You take 7,000 here, you get EBIT. Okay. Now from this, you have to minus interest. Interest is directly given in the problem, that is 4,000. You have taken 4,000, you got EBT as 13,000. There is no tax information given, so you will less tax, as no information is given, take it as 0. So EAT is 13,000, earnings after tax. Now they're telling you to calculate operating, financial, and combined leverage. What is the formula for operating leverage? Contribution divided by EBT. Just substitute the figures in the formula. Contribution is 24,000, EBIT is 17,000. When you divide the two, you will get your operating leverage as 1.4 times. Similarly, financial leverage. The formula is EBIT divided by EBT. Just pick up the figures from the format that we have solved, that is 17,000 divided by 13,000, you get the financial leverage as 1.31 times. Combined leverage, students, again I'm repeating, either directly multiply the operating and financial leverage, you'll get the answer of combined leverage, or the formula of combined leverage is take the numerator from operating leverage, take the denominator of financial leverage, you will get the combined leverage. So combined leverage is a combination of operating and financial leverage. So it is nothing but contribution divided by EBT. So 24,000 is a contribution divided by EBT is 13,000. You get the combined leverage as 1.8 times. So this is how we have solved operating, financial, and combined leverage for A. On the same line, students, you have to solve it for B and C. Is problem number 2 clear to everyone? Yes, students? Yes?
Yes, ma'am.
Okay. Now let us move ahead to problem number 3. This is from previous year question paper 2016. Okay. Calculate operating, financial, and combined leverage for the following firms. So there is PQR. Units are separately given 3 lakh rupees for P, 75,000 for Q, 5 lakh for R. Fixed cost is given, variable cost per unit is given. Interest expense is nothing but again your financial cost, and selling price is given. Now I will solve it for P on the same lines you got to solve it for Q and R. So let we know to calculate leverages, we again need contribution, EBIT, EBT. So we have a format for it. So first we take sales. How did I get the sales of P as 9 lakh? Because the sale unit for P is 3 lakh. The selling price is 3. So 3 per unit into 3 lakh units, you got 9 lakh as your sales. Less variable cost. Variable cost is rupees 1 per unit. So rupees 1 into 3 lakh is 3 lakh is your variable cost. You got contribution as 9 lakh minus 3 lakh, that is 6 lakhs. From that you have to less your fixed cost. Fixed cost is directly given in the problem 3 lakh 50. So you minus 3 lakh 50, you got EBIT as 2 lakh 50. From that you have to less interest. Interest is directly given in the problem 25,000. When you minus this 2, you get your EBT. Since no information about tax is given, we have taken at nil. So EAT, earnings after tax, is 2 2 lakh 25,000. How do you calculate leverage? There are three leverages. First, operating leverage. Formula is contribution divided by EBIT. You just substitute the figures. You got contribution as 6 lakhs divided by EBIT, that is 2 lakh 50. You got operating leverage as 2.4 times. Financial leverage, the formula to calculate financial leverage is EBIT divided by EBT. So EBIT is 2 lakh 50, okay, which we have solved here, students, and EBT is 2 lakh 25,000. So you got the financial leverage as 1.11 times. Combined leverage, you have two formulas. Either you combine this two. So what I have done, operating leverage into financial leverage, combine. So 2.4 into 1.11 times. When you multiply these two answers, you get the combined leverage as 2.64 times. There is one more formula where you take the numerator of operating leverage and the denominator of financial leverage. That is, when you divide contribution with EBT, you get the combined leverage answer, which will again be same, that is 2.64 times. So if you do 6 lakh divided by 2 lakh 25,000, you will get combined leverage. In exam, you can use either of the formula, both will give you the same answer. On the same lines, students, what we have solved for P, you got it to solve it for Q and R. You will get the answer. Is problem number 3 relating to leverages clear? Yes, students?
Yes, ma'am.
Yes, students? Okay. Let us move ahead to problem number 4. The following, this is come from the previous year question paper 2014. The following is the balance sheet of Z Limited on 31/3/2014. They have given you liabilities, they have given you assets. Under liability, you have share capital of 1 lakh 80, 10% debenture 2 lakh 40. When I say 10% debentures, means interest on debentures is 10%, student. So total debenture is how much? 2 lakh 40 into 10%. Means the interest cost, financial cost here will be 10% of 2 lakh 40, that is 24,000 is your interest. Less retained earning, retained earnings is given 60,000, current liability is 12 lakhs. Your fixed assets is given for 4 lakh 50, current asset is given 1 lakh 50. Okay, the company's total asset turnover ratio is 2.5 times. What is the meaning of turnover, students? Turnover is nothing but your sales. Okay, so total asset turnover ratio is 2.5 times. The fixed cost is 2 lakhs given. The variable cost is 40%. And I told you variable cost is always related to your sales. So suppose if your sales is X, your variable cost will be 40% of X. And income tax is given as 50%. Calculate the three leverages. By three leverages, they mean operating, financial, and combined leverage. Now, students, here, sales is not given here. So if sales is not given, how can we move ahead? Because in order to calculate contribution, EBIT, EBT, the most important element that we start with is sales. Sales is not given, but information to calculate sales is given. Students, in your first semester, you have learnt about ratios. So total asset turnover ratio, what is the formula for total asset turnover ratio? It is nothing but total assets divided by your turnover, and turnover is nothing but your sales. Okay, so we do a working where we are going to find out the sales figure. So let us move ahead to the working. Calculation of sales. Asset turnover ratio is sales divided by total assets. So we know that the asset turnover ratio is 2.5 times. Sales is unknown figure. Total assets, you can take it from your balance sheet. So here is a balance sheet. What is the total assets? It is 6 lakh. So 6 lakh is your total asset. So when you multiply 2.5 into 6 lakh, you get the sales as 15 lakhs. So once we got the sales, once we got the first element to solve the leverages, okay, we can start with the solution. So sales, we have derived this sales figure from working note number 1, that is 15 lakh. Less variable cost is given as 40%. And I told you variable cost is always related to your sales. So 40% of your sales It'll be 6 lakh rupees. That is 40% of 15 lakh you got as 6 lakh. So you got your contribution as 9 lakh. That is 15 lakh minus 6 lakh. Less fixed cost. Fixed cost is directly given as rupees to 2 lakhs. So you got as EBIT 7 lakhs. That is contribution minus your fixed cost. 2 lakhs you got EBIT as 7 lakhs. From that EBIT first you have to minus I. I is nothing but interest. Now, interest to the debenture holders, I told your students, 10% of 2,40,000 is nothing but 24,000. You got EBT as 6,76,000. From that, you have to less your tax. Tax is given in the problem as 50%. So 50% of 6,76,000, you get 3,38,000. So your EAT is 3,38,000. Once you have got all this, you can easily solve the different three types of leverages. So your operating leverage formula is contribution divided by EBIT. So what is the contribution? 6 lakh divided by EBIT is 7 lakh. You got your operating leverage as 1.29 times. Your financial leverage formula is EBIT divided by EBT. So that is 7 lakhs is the EBIT that we have calculated, divided by EBT is 6,76,000. You got your financial leverage as 1.04 times. Now combined leverage can either you can multiply these two answers. Either you can multiply 1.29 times into 1.04 times. You will get the answer of combined leverage. Or you use the formula. Formula is contribution divided by EBT. When you do 9 lakh divided by 6,76,000, then also you will get the answer of combined leverage, which will be same. So here I have simply combined the operating leverage and financial leverage. That is the answer of operating leverage as 1.29 into the answer of financial leverage, that is 1.04. So the combined leverage that I've got is 1.34 times. Students, is problem number 4 clear to everyone? Just remember for leverages we require contribution, EBIT and EBD. Once we know the format, we have to just put in the figures, punch in the figures in the format and get the answer for different types of leverages. Is problem number 4 clear to everyone? Yes, students? Yes?
Yes, ma'am.
Okay.
Yes, ma'am.
Now let us move ahead to problem number 5. This is from the previous year question paper 2018. Why I'm solving the question papers is means you all will get a rough idea as to what type of problems will fall in the exam. So your capital is given for A and B 6 lakh and 3 lakh 50. 12% debentures. When I say 12% debentures means interest to the debenture holders is 12% on 4 lakh rupees for A and on 6 lakh 50 for B. Sales is given 60,000 units for A, 15,500 for B. Selling price per unit 30 and 250 is given. Fixed cost 7 lakh and 14 lakhs is given. Variable cost 10 per unit for A and 75 per unit for B is given. Calculate the three leverages assuming tax to be at 50%. So first thing when you get such problem in your exam, you have to see for leverages, three types of leverages, what all we require. We require contribution, we require EBIT and we require EBT. So first thing for contribution, what are the two things that you require? Sales and variable cost. So you require to prepare the format. So particulars company A, company B. Sales. See students, I will solve it for company A. On the same lines, you have to solve it for company B. So sales. How did you get 18 lakh? The total units of sale for A is 60,000. 60,000 into 30. You got 18 lakhs. Less variable cost. Variable cost is 10 per unit. The total unit is 60,000. So 60,000 into 10 per unit, you got 6 lakh. Your contribution is 18 lakh minus 6 lakhs, that is 12 lakhs. Less fixed cost. Fixed cost is directly given in the problem, 7 lakhs. It will remain fixed. So minus 12 lakhs. From 12 lakhs minus 7 lakh, you got EBIT as 5 lakh. From that, you have to less interest. How you got this interest of 48,000? You have taken 12% of 4 lakh. You got 48,000. You got EBIT, earnings before tax. Before tax, the earnings is 4,52,000. From this, you have deducted tax at the rate of 50% of 4,52,000, that you have got is 2,26,000. You got earnings after tax as 2,26,000. Now, based on only these information, you can calculate all the three leverages, because the formula for operating leverage is contribution divided by EBIT. The formula for financial leverage is EBIT divided by EBT. The formula for combined leverage is contribution divided by EBT. So just substituting the figures in the formula. So contribution divided by EBIT is nothing but 12 lakh divided by 5 lakh. You got 2.4 times as your operating leverage. Financial leverage is EBIT divided by EBT. So that is 5 lakh divided by 4 lakh 52,000. You got 1.11 times. Combined leverage, as I told you all, either you can use the formula or you can combine the answer of operating and financial leverage. When you're combining, you got to multiply, not add. So 2.4 times into 1.11 times, you got the answer as for combined leverage as 2.66 times. Or either you can use the formula. The formula is contribution divided by EBT. That is 12 lakh divided by 4 lakh 52,000. You get the answer of combined leverage. Same 2.66 times. On the same similar lines, you have to solve for company B. There is no difference. But you have to use the figures given for company B. Use these figures for company B. On the same lines, you can solve it. You will get the answer. So is problem number 5 clear to everyone? Yes, students?
Yes, ma'am.
Okay. So by this, we have completed the problems on leverages. So thank you so much, students. We are done for the session for today. Thank you so much. In our next session, we will be seeing EBIT and EPS